We're now going to have a look at the two main strategies for managing working capital management. So we've been looking at controlling of current assets, the controlling of your current liabilities, but what can the business do outside of controlling things on a day-to-day basis from a strategic point of view to ensure that they have effective working capital management? The two main things a business can do are undertake leasing or a sale and leaseback strategy. So we've spoken about leasing again as a short-term finance option from a debt perspective. We have a good understanding about what leasing is, and it's a key strategy for a business and a strategy a business might utilise to improve its working capital. So really to ensure it has more current assets than current liabilities. Because leasing allows a business to hire equipment rather than making a large cash outlay, it's going to improve the cash position of the business, which ultimately is your current assets, which ultimately leads to a more effective current ratio or liquidity ratio and working capital of that business. So it helps to preserve working capital because the outlay is less, as I've said. Lease repayments are usually tax deductible, so there's a tax advantage there as well. And it's easier to budget for lease repayments because they're stable. You generally pay the same amount every month rather than one big lumpy amount of cash that the business has to pay to purchase a large piece of equipment, such as a crane or motor vehicles or even a large number of laptops for a business. So that's an effective working capital management strategy. Lease, you're not outlaying a significant amount of cash in one time, and you're just paying for things on an as-needs basis out of cash. The second strategy is that of sale and leaseback. So not dissimilar, but this is where a business owns an asset of value which they use, and it's often land, and they choose to sell that to another party and then lease those premises back. So the business sells the asset or the equipment and then agrees to lease back that equipment or land for a defined period of time at a certain cost. What's the benefit to the business? Well, the business gets a large cash injection because they make the sale, but they still get to utilise the equipment or the land for the benefit of the business. An example at the moment is that the Ingham family, who are the chicken farming family, they are in the process of looking to sell off some agricultural land out in Western Sydney, where they'll sell it for about $1 million an acre, but then they'll agree to lease back that land to continue to operate the chicken farm that they have out there, which I think it's out at Leppington. So that will allow them to get in a lot of cash in the form of from the sale of the land, but then they'll agree to continue to operate that land for their own business at an at a monthly lease cost. So the advantage, they get an injection of cash, and the added advantage is they get to continue to use that land as per the agreement of the sale of that land. So there are your two key working capital management strategies that businesses can use if they need to improve their working capital management, i.e. current assets minus current liabilities.